Indonesia, a nation on a trajectory of development, relies heavily on tax revenue. This revenue stream is the lifeblood of the nation's progress, funding essential public services and infrastructure projects. From education and healthcare to transportation and energy, tax revenue is the cornerstone of Indonesia's development initiatives. A robust tax system ensures a steady flow of funds, enabling the government to invest in critical areas and uplift the lives of its citizens. Without a reliable tax base, Indonesia's development agenda would face significant hurdles. Therefore, ensuring tax compliance is not just an economic imperative, but a social one, directly impacting the well-being of the Indonesian people. However, challenges persist in maximizing tax collection. The complex financial landscape, coupled with sophisticated tax avoidance techniques, poses a threat to Indonesia's revenue potential. Addressing these issues is crucial to secure the nation's financial health and ensure sustainable development. Indonesia's tax system has undergone a transformative journey, transitioning from an official assessment system to a self-assessment model in 1993. This shift marked a significant step towards empowering taxpayers, granting them the responsibility of calculating, depositing, and reporting their taxes. Under the previous official assessment system, tax authorities determined tax liabilities, often leading to disputes and inefficiencies. The self-assessment system aimed to streamline this process, fostering greater transparency and taxpayer accountability. This reform also saw the introduction of various taxes, including income tax, value-added tax, and sales tax on luxury goods, broadening the tax base and diversifying revenue streams. While this transition marked a significant milestone, it also presented new challenges. The self-assessment system relies heavily on taxpayer honesty and accurate financial reporting. However, the emergence of sophisticated financial engineering techniques has created loopholes, enabling some corporations to minimize their tax liabilities, ultimately impacting the effectiveness of the self-assessment system. Financial engineering, a double-edged sword in the realm of finance, involves intricate financial transactions often aimed at achieving specific financial goals. While it can be utilized for legitimate purposes such as risk management, it can also be exploited to minimize tax liabilities, blurring the lines between ethical financial management and tax avoidance. Tax avoidance, a legal practice, involves exploiting loopholes and ambiguities in tax laws to reduce tax payments. While not illegal, aggressive tax avoidance can significantly erode a nation's tax base, impacting its ability to fund essential services. Tax compliance, on the other hand, represents the cornerstone of a fair and equitable tax system. It refers to the degree to which taxpayers adhere to tax laws and fulfill their tax obligations. Understanding the interplay between financial engineering, tax avoidance, and tax compliance is crucial in navigating the complexities of the modern financial landscape. This understanding is particularly important for tax authorities, who must constantly adapt their strategies to combat sophisticated tax avoidance techniques and ensure a level playing field for all taxpayers. The palm oil industry, a significant contributor to Indonesia's economy, presents a compelling case study in financial engineering. The industry's complex supply chains, often spanning across borders, provide ample opportunities for profit shifting and tax avoidance. One common practice involves transfer pricing, where related entities within a multinational corporation manipulate the prices of goods and services to shift profits from high-tax to low-tax jurisdictions. This manipulation reduces the overall tax burden for the corporation, but at the expense of the countries where the profits are generated. Furthermore, the industry's reliance on subsidiaries and complex ownership structures can obscure financial transactions, making it challenging for tax authorities to track income and expenses accurately. The palm oil industry's financial engineering practices highlight the need for greater transparency and stricter enforcement of transfer pricing regulations. Failure to address these issues could result in significant revenue losses for Indonesia, hindering its development goals. All right, let's dive into the basics. First, we need to understand the fundamental principles that govern this topic. It's crucial to grasp these core concepts before we move forward. So let's break it down step by step. By the end of this section, you'll have a solid foundation to build upon. Ready? Let's get started. In this scene, we explore how companies can exploit balance sheet accounts to minimize their tax liabilities. By strategically managing accounts such as inventory, receivables, and payables, businesses can defer or even reduce their taxable income. This practice, while often legal, requires a deep understanding of both accounting principles and tax regulations. Now let's dive into the impact of these strategies on corporate income tax, or PPH, and value-added tax, commonly known as VAT. When companies adjust their balance sheet accounts, it can significantly alter their tax obligations. For instance, deferring income recognition can lower PPH in the current period, while manipulating inventory levels can affect VAT liabilities. These tactics, though complex, are crucial for effective tax planning. Moving on, we examine the role of ERP systems in tax compliance and avoidance. Enterprise Resource Planning Systems, or ERPs, integrate various business processes and data, providing a comprehensive view of a company's financial health. These systems can be leveraged to ensure compliance with tax laws, but they can also be used to identify opportunities for tax avoidance. The key lies in how the data is managed and reported. Finally, we discuss the importance of strengthening Indonesia's fiscal future. By closing loopholes and enhancing tax regulations, the government can ensure a more equitable tax system. This not only boosts revenue, but also fosters a fairer business environment. It's essential for policymakers, businesses, and citizens to work together toward a sustainable fiscal future for Indonesia.